Crisis is not over. We've got a growing list of banks on the troubled list or watch list. We have over $500 billion in unrealized gains. We're going to talk about that and much, much more. But first, I want to give a special shout out to Sean Cannell at Think Media and our boy Simon, the Uneducated Economist. I don't know if you've seen it yet this morning. It's only been out for a couple of hours, but the great Uneducated Economist has been interviewed by Sean Cannell at Think Media. He is talking about how he has grown his YouTube channel to over 130,000 subscribers from his car without editing videos. Folks, I know a lot of you that follow this channel are just starting your journey. I know the journey is slow in the beginning. I know you have to find your voice, but trust me, just keep going. And of course, let's do Simon and Sean a favor. If you have the time, go check out that video. Much respect to Sean for spending several hours with us in Vegas, and Simon for coming out and keynoting the Vegas event. So congratulations and thanks to both of you. All right, folks, let's talk about the banks. We have known for quite a while that with the rapid rise in interest rates, that there was going to be this thing called unrealized gains. Unrealized gains are basically magic that allows banks to hold assets or bonds on their balance sheet until completion, right? Until basically for the full term. Because if you buy a bond and it's paying 2% and rates go up, that bond is less valuable. It's called an unrealized gain. This is what took down Silicon Valley Bank. Silicon Valley Bank went basically all in on treasuries. Treasuries, obviously, the rates went up, the value went down. And instead of holding to maturity, they were forced to sell. And the dominoes fell and bingo, bango, gonzo. So we just got a published report from the FDIC. Unrealized gains in the banking system, $517 billion. That's $500 billion. That's a little bit more than $500 billion. Now, let's be clear. Unrealized losses are not necessarily bad. There are plenty of banks, think JP Morgan, that have the balance sheet to hold to maturity. So if the financial institution has the capital, has the balance sheet to hold to maturity, frankly, it's a nothing burger. It's a nothing. However, what you and I need to be watching, and frankly, the FDIC is watching, is there's a lot of institutions that their balance sheet is getting stretched, their ratios are becoming problematic, and if it gets bad enough, they will be forced, a la Silicon Valley Bank, to sell these assets and take unrealized gain or unrealized losses, to realized losses, and that could be a disaster. The bank in one quarter, or the FDIC in one quarter, identified 63 banks on their troubled, on their watch list, they call it. That is up from 52. So, yes, I meant unrealized losses. If I messed up somewhere, my apologies. Thank you for the catch. So again, 63 institutions, just so you know the scale of this, that is only 1.4% of all banks. Now, like you, I'm like, okay, is 1.4% bad, good? Are we in the range? What happens in quote unquote normal times? Well, the reality is there are always banks. Well, I shouldn't say always. I am not aware of any time there wasn't at least some banks on the watch list. There are, according to what I found, the normal range is between 1% and 2%. So again, we need to watch this. It's trending the wrong direction, 52 to 63. So again, we need to watch it. Not earth-shattering today, 1.4, normal range 1 to 2. The other things that we could take comfort in, because remember, Silicon Valley Bank demise was like 250 or 263 billion dollars. The totality of the 63 banks on the watch list, their assets equal 82 billion combined. So these are small. Heck, these might be even classified as tiny banks. These are likely institutions with 2, 3, 4, 5, maybe 6 branches. So again, something to watch, something that certainly could get worse. But the 63 banks on the list, even if all 63 went kaput, not enough to, not even, what is that, roughly? Not even 30% of just what Silicon Valley Bank was, all of them combined. So again, very, very interesting. I do think that we need to watch this going forward because, again, we have a problem. If rates stay high for longer, which many of us are calling no rate cuts in 2024, I believe the real pain, as I've said before, is in Class B and Class C multifamily. We had a conversation over the weekend or a live stream where I highlighted one of my buildings, given the NOI and historical cap rates, would be worth roughly $1.2 million. During the nuttiness, it went up to $2 million. Now, given the revisions, it'll be worth 1.1. And of course, if you're going to refi at 1.1, you're going to get debt at about 800 grand. So it's ugly out there. As you've heard from Ken McElroy, you've heard from Grant Cardone, Class A assets are trading. That is a good thing. However, as I talk to more and more brokers across the country, Class B and Class C are not trading. In fact, if you go back and look at some of my videos, you will see comments from commercial brokers talking about folks that have 38 and 50 and 16 units that can't sell, that they're in trouble. Folks, the greatest opportunity for wealth generation is in front of us. It is in the small multifamily, meaning 5 to 40 units, maybe 5 to 50 units. Too small for the big boys. But man, there is a lot of bad debt, bad operators, financial engineers who are going to lose the asset, and we are going to get a deal. But again, there's a lot of commercial banks that will be hurt because, again, if they have to take their unrealized losses from multifamily and make them realized, that could be nasty. Folks, we've talked about disrespectful offers for a long time. In fact, to give credit where I heard it first was Patrick Bet-David. I have done some research, and I think I have found the most disrespectful offer ever. If you can find a more disrespectful offer than the one I'm about to tell you about, I want to hear about it. Here we go. 1978. 1978, Richard Branson, CEO of the Virgin, group, monopoly, whatever you want to call it, brand. Richard Branson, apparently, if the story is true, was trying to impress a girl. And he went after a private island. This private island was listed for $6 million. Any guesses on what Richard Branson offered? You know what? Let's have fun. Let's have fun with this live stream. We're going to take a couple of seconds. You're going to put some comments below and let me know what you think he offered. Again, list price was $6 million. I have already told you that I believe this is the most disrespectful offer ever. We've had one guess of $2 million. Let's get another couple and we'll see what you guys have to say. You know what? While you put those in, I'll move on to the other topic and we will come back to this. Let's talk about Mike Simonson from Altos Research. He's talking about active inventory in the real estate game being up. We are now up 1.7% to a total of 605,000. 1.7 month on month, 39% year on year, folks, and that is a good thing. The housing market is slowing down. We had 76,000 new listings. That is up 10% year on year. However, and we only had 13,000 quote unquote immediate sales. Those are things that went into contract within 48 hours of listing. That is lower than normal. We are starting, according to C for Mike Simonson, prices slip. Prices are going down, folks. There's a lot of channels out there accurately talking about pain in Texas and Florida. They are absolutely right. You are seeing some real pain in Florida and Texas. So again, there are going to be some states, some cities, and some buy boxes where prices are going down. Okay, now back to 1978 and Richard Branson and the biggest disrespectful offer I have ever heard. $6 million trying to impress a girl. He offers 100 grand. 100 grand. 100 grand. That's not even 2% of list price. You know the cojones on that guy? And again, he didn't think he'd get the deal. But guess what? The seller countered. The seller countered. The seller countered. He ends up buying Necker Island, which he still owns today, for 180 grand. He bought it for 180 grand. List price was $6 million. Now, it's very interesting. 1978. Where have you and I talked about 1978 before? 1978, if you go back and look at the 50-year spreadsheet, which again is on my website and free, if you go to that, you will know that 1978 was the peak in real estate transactions for 14 years. For 14 years, we did not see real estate transactions exceed 1978. So what likely happened is this individual got caught. They needed cash. And he was the only buyer in an environment, and he took 180 grand on a $6 million list price. Now, again, I want to hear from you. If you have a more disrespectful offer that actually closed, I'm not talking about ones that don't close. I want to know the ones that close. Richard Branson, you are the king of disrespectful offers. Congratulations. Alrighty, folks, I want to let you know about something exciting coming to the school community. A lot of you in the school community have talked about wanting to speak with a CPA, an accountant that was real estate oriented. Well, great news. Today, yes, surprise, surprise, surprise. Today at 10 a.m., so I don't know, 2.5 hours from now, you are going to get to talk to Bob Langworthy, CPA at Maine Bean Counters. That's Maine is the state. He is the accountant to the stars, meaning to me and Olivia, as well as the lumberjack landlord. Again, if you want to ask questions, you want to talk bookkeeping, I have set up a call for the school members, 10 a.m. today. The Zoom link's in the calendar. Enjoy. We will be recording it. If you miss it, we will publish it in the school community. Again, if you want to join the school community and be a part of this, you still have some time. I will put the link below. This is a video that likely will live only on school because it likely will have personal information. I don't want to blow it up on YouTube. If there's no personal information, maybe we'll throw it on YouTube, but I doubt it. Again, you guys wanted it. I used my Rolodex. We are bringing you a CPA in 2 hours. Not to be outdone. Of course, you've got Jonathan Twomley Thursday at 7:30 to talk about big apartments where the opportunity is, how to network. How many of you have said, Zuber, I hear you. I know where the opportunity is. It's not houses. It's small multis. How do I network? How do I find? What do I do? Well, damn it. Join school and ask Jonathan Twomley. He has been doing this for a long, long time. We're going to bring you that on Thursday. And coincidence, Simon, the uneducated economist, again, go check out Think Media for that interview. Again, 136,000 subs, no editing from his car. Respect. We're going to get Simon at 9 a.m. on Sunday to interact with the school community. And folks, we are over 80 students already. Remember, when we get to 100, we're going to start making sure some data, some videos, some important stuff only lives on school. Folks, it's $20. It's $20 a month. You're going to get access to millionaires. I'm going to do monthly calls, Q&A, at least one. Lots of value every week. So again, join. All right, folks, what else is going on? Well, we got the JOLTS report. Again, JOLTS report, basically job openings. This is something that peaked at like 10.7 million, something like that. It might have gone over 11. Let's do the three numbers, right? What was it last? 8.5 million. What was expectations? 8.4 million. What happened? 8.1. Folks, the job market is clearly rebalancing, softening. I suspect, I haven't checked this morning, I probably should have. I'm guessing the 10-year note is down. It would not shock me if we get a weak ADP report tomorrow and a weak jobs report Friday that mortgage rates are once again under 7%. Folks, again, stagflation. Woo! I don't know. Jerome Powell in this whole, I don't see the stag or the flation. He is going to regret that. We already have GDP coming in sub 2%. We've got inflation around 3%. And now we have a weakening job market. Also, we got the ISM Manufacturing Index. Remember, these numbers are wacky, but all you care about is below or above 50. The expectations for the index was 49.6. Again, slight contraction. Came in at 48.7. A miss to the downside. So again, the economy is weakening. And then lastly, folks, it looks like the YOLO, the you only live once economy, the revenge spending that we started talking about 3 years ago. Folks, yes, we have been talking about revenge spending for about 3 years on this channel, is finally wearing off. What does this mean? It means the consumer is getting more conservative. We are scared. We are fearful. And when the consumers get fearful, they pull back. And the consumer, given 70% of the economy, can cause a recession all by itself. And then lastly, folks, bad news is no longer good news. We have gone through probably 2 or 3 months where bad news was good news, meaning bad economic news was good because, hey, the Fed's going to cut. Now, folks, I think we've realized that bad news is bad news. Bad news means a recession. Bad news means earnings per share down. Bad news is bad news. So, folks, a lot of stuff going on. I hope you appreciate these daily financial news. I love doing them. I have a blast talking to you for 15 to 20 minutes every day. I'm really encouraged and excited by all the value going on in school. Again, once we get to 100, and that might happen today because you all want to talk to CPAs, you want to talk to syndicators, you want to talk to the uneducated economists. It's all there for you. Don't forget Jason Pritchard's videos up. We've got the 6-hour masterclass, creative financing. I gave you my 10-week boot camp, which is over $1,000. Come join the party. All right, folks, I'll see you later. And if you're in school, I'll see you at 10 o'clock to talk to Bob Langworthy, the CPA. One more time. Congrats, Simon. Congrats, Sean. I look forward to watching that video. Both of you are amazing. Later.